The last 10 years, since, well, 8 years anyway, we've seen a kind of crisis and collapse of Western economies that we hadn't seen since the Great Depression of the 1930s. And so many economists have tried to figure out what might have happened. And some people had theories beforehand about that might explain what happened. So I'm going to try and describe why there was this boom and bust that happened in 2007 through 2009 that we still haven't recovered from. And although I know things here have gone better than they did in North America and in Europe, but try to explain what happened in North America and Europe in 2007, 2009, and still going on now. But also this explanation, I think, is a universal explanation for booms and busts, that there have been many before, and I think the same explanation applies to them. So that's what I'm going to talk about. So the title I gave was Leverage, Default, and Forgiveness. I think those are the key ingredients about what caused the crisis, what happened immediately during the crisis, and what would have been the only way to get out of the crisis quickly. So as I said, I think the leverage cycle, as I call it, caused the crisis. Forgiveness would have fixed it. And the main lesson that we've learned is that I think the Federal Reserve and central banks ought to think a little bit differently about financial stability. And they have to think beyond interest rates, and they have to think in something a little more general that I'm going to talk about called the credit surface, and maybe they should think about forgiveness as a policy tool. So I first wanted to cycle. So I'll give you a little bit of personal history. So some people know this personal history, but anyway, I'm going to repeat my personal history. In 1989, I was teaching at Yale University theoretical economics, and it was all about existence and Pareto efficiency and mathematical economics. And so I was sort of proud that I didn't really know that much about the world, because I wanted to think purely about the logic of economics and not be cluttered with too many facts. But I decided maybe after all I should go to Wall Street and see what they were doing, what mathematical finance was. So in 1989 I went to a firm called Kidder Peabody. Now, it was fashionable at that time to go to Goldman Sachs. That was the most famous, most intellectual, the most successful investment bank. And several friends of mine had already gone there, and they arranged for me to go there. But I had a little cousin who was just graduated from college, went to Harvard actually, and he had been interviewed by the person who was the number 2 person at Kidder Peabody, who decided they needed to get some more outstanding undergraduate students to come work there. So he personally went to Harvard to recruit students, and my cousin went there. And so my cousin said, the guy just interviewed me. I think he's going to remember me, and he'll meet you. So I met the person who was, basically the number 2 guy at Kidder Peabody. And he said, why go to Goldman Sachs and be one of 100 economists sitting in a corner solving some mathematical problem? Come to Kidder Peabody, which was the number 7 investment bank at the time, much smaller. Come to Kidder Peabody and talk to me about how the firm really works. So I said, okay, maybe I should do that. I'm only there for a year anyway. So I went there, and I did talk to him all the time. And at the end of the year, he said, listen, You've convinced me that we're not very mathematical. I already knew that already at Kidder Peabody compared to Goldman Sachs, but I never had the energy to hire a whole new research department. Why don't you hire me a research department? You know how to, give exams and judge people. You interview the people and decide who to hire. So I didn't really know much about all the fields I was interviewing in, but I found that if you interview enough people in the same field, they tell you what it's about. And by the time you've gone through, you just hire the guy with the best story. So I I hired a research department, and then this was the end of 1990 by then, the summer of 1990, and I went back to Yale, and then he calls me. I hired 25 people. I went back to Yale, and he said, you know, you haven't finished hiring all the people. You've hired the main top people, so why don't you run the department? Since you've hired everybody, run the department from Yale, and you'll enjoy it, and it'll be, you know, we can keep talking. So I didn't realize how much trouble that was going to get me into, and how much time it would take, and how many people quit, and how many times the models would be wrong, and the traders would go crazy and blame the research department, which means me. And so I had a lot of trouble, but I learned something quite amazing. A couple years later, my cousin, who was he was now 24, he was a mortgage trader, and the head mortgage trader got fired because he was buying things for his own account. And so my cousin was promoted to be the head of mortgages. And so he was a little bit more aggressive than the previous guy, and he decided Kidder Peabody should be the leading player in mortgages. And so the way mortgages work, you may not know, is when you get a mortgage as a homeowner, you promise the bank to pay money in the future, and the bank buys your promise. They lend you money, but really they're buying your promise. So then you pay gradually. But what your homeowner doesn't know is the homeowner's still sending the money to the bank, but the bank meanwhile sells the promise to Fannie Mae or Freddie Mac, these government agencies, and they pool together the promises in these big mortgage pools. So the bank just takes the money from the homeowner and sends it to the pool. Then the investment banks, like Kidder Peabody, they buy the pools and they cut the pools into pieces. So instead of paying $1,000 a month, it might pay $500 plus a multiple of the interest rate. That's called a floater, because it pays more as the interest rate goes up. You cut another piece into $500 minus a multiple of the interest rate. So they add up to $1,000, but the other one's called the inverse floater, because it pays more as interest rates go down. So you sell the first piece to people who need the money when interest rates go up. You sell the second piece to people who need the money when interest rates go down. And you can sell two pieces for more money than you can sell the original plain vanilla piece. Okay, so that began in 1986. It's called securitization and tranching. Tranching, French for splitting. So my cousin decided, the pieces were getting a little more complicated. There were 20 of them or 30 of them. And so every other investment bank was going around to saying to 20 different buyers, we're going to create this piece hypothetically. How much would you pay for it? How much would you pay for it? You get the 20 numbers. If it adds up to more than the pool, you buy the pool and sell off the pieces and you make a profit. So my cousin said, look, we're going to find a buyer for the most dangerous piece. And once we've got a price, a hard price for that piece, we'll borrow the money, buy the whole pool, and then sell off the other 19 pieces, when we can find the buyers. So because he only had to sell one piece instead of 20, he was going much faster than everybody else. And Kidder Peabody went from a negligible player way ahead of everybody else. In Kidder Peabody, there were 40 banks creating these, and Kidder Peabody did 20% of the market within a year or so. So my cousin managed to completely dominate the market just because he was more aggressive. And now the research department had to figure out how to hedge all the 19 pieces and to figure out the cash flows and things like that. So I got very interested in mortgages. And anyway, the first thing I realized was that mortgages was the most interesting part of Wall Street, the most mathematical. I always thought it was equities and options and currency trades, but much more complicated than that was the mortgage business. Behind the scenes, the homeowner just thinks that, he's sending money to the bank or she's sending money to a bank. Little does she know that the bank has sold it, the pieces have been tranched, there are all these wild things happening. But behind every single one of those trades is collateral, because the homeowner makes a promise. The bank doesn't trust the homeowner has to pledge the house as collateral. So if the homeowner doesn't pay, they take the house. And then the pieces, the 20 pieces that the pool is cut into, are backed by the cash flows from the pool. So the pool is collateral for the tranches. The homeowner's house is collateral for the homeowner's promise, which is collateral for the pool. And then when the buyers buy the pieces, they don't pay cash. They borrow the money to buy the pieces, using the pieces themselves as collateral for the borrowed money they used to buy the piece. So I realized the whole thing functioned by collateral, and I had never read in a single macroeconomics textbook the word collateral. It just never appeared. So I thought, my gosh, this is something I ought to be writing about or thinking about. So that's how I came up with the idea of collateral equilibrium, which, remember, was part of my title. Collateral was very important. The whole purpose of the financial system is to make promises that the buyer can believe in, and to guarantee the promises, you need collateral. Okay, so in 1994, things were going great. My cousin, the mortgage business, was dominating the market. They were making a huge amount of money. And then one day, there was this terrible catastrophe in the government bond department at Kidder Peabody. Some government bond trader managed to lose $300 million. And so it was the first of the scandals on Wall Street. There have been 25 of them since then. You know, the Great Whale is the most recent one, a much bigger catastrophe. But anyway, at the time, that was $300 million, was regarded as a huge catastrophe. So I get a call. General Electric owned Kidder Peabody, and they called us up to New York. I mean, I was at Yale, so they called me back to New York, and I had to go in and invite the 75 people by then who worked in my research department. I'd say, you're fired, you're fired, you're fired. And after the 75th person, I got up and I went next door, and the guy said, you're fired. And so General Electric closed down the company. After 135 years, Kidder Peabody closed. So my cousin then says, well, this seems terrible, but you know, it may not be so bad, because everybody's trying to imitate me now. Those complicated pieces, you know, that we sold and then borrowed the money to buy the others. Now all the other investment banks are doing the same thing. So everybody's trying to sell the complicated piece. And so many investment banks competing, the price of the most complicated piece is getting so low, the guy making all the money now is the hedge fund that's buying the complicated piece, the only one willing to take the risk. So the money now is not in the investment banking, it's being a hedge fund and buying the complicated piece. So we founded Ellington Capital Management in 1994. And so we're buying these complicated pieces for almost nothing, because everybody thinks they're so dangerous, and making, you know, things are going great. And so we're making almost 50% returns the first 3 years. And then in 1998, I get another call, and I'm at Yale again, and I rush down to Greenwich now. It's this little town halfway between New York and New Haven where many hedge funds are. So I rush down there, and the marketing guy says, it's over, John. And so I said, what do you mean? And so it turns out we got a margin call. So we were buying the complicated pieces like everybody else, borrowing. So if the piece cost $100, we would borrow 80 and then pay 20 of our investors' money to buy the piece at 100, hoping it would go up to 150. So the trouble is, if the piece goes down in value and isn't worth 100, then the lender starts to get nervous, and they figure you've borrowed 80, they have the collateral of 100 protecting the $80 borrowing, but if the 100 goes down in value, now the lender feels nervous, so they make a margin call. They say they want more of the difference, and so they want more cash. So what happens is at 10 in the morning, you get a margin call. They say you need, you know, $500 million. And if you don't have the money by 4 o'clock that afternoon, then they can sell all the pieces and get their money back. But of course, they have no incentive to sell the piece for above 80, because if they sell it for 80, they get their money back. The fact that you've lost all your investors' equity doesn't matter to them. So that's why the salesperson said it was over. They're going to sell off all our pieces the next morning. Actually, it was a Friday at 4 o'clock. So and Monday was a holiday, Columbus Day, so they weren't going to be able to sell it till Tuesday. So, but Tuesday morning they would sell it all off, and we'd probably be wiped out. So, this seemed horrible. So I began to think to myself, my God, this is twice a company I've worked for is going out of business. I mean, can it really be all my fault? And but my cousin, I was just having this, my cousin though, a man of action, he says, we can't wait till Tuesday before they sell all this stuff off for 80. We're going to sell it ourselves over the weekend. So he calls up all the other investment banks to tell them we're going to try and sell these pieces. But of course, it's not very likely that we're going to be able to do them. So he calls Warren Buffett, who's a very rich, maybe the second richest man in the world or something. And he says, look, our hedge fund is getting a margin call. They say that the price of these pieces went down, but they haven't gone down at all. They're just getting nervous, and they want to force us to sell. They're going to sell so many things at the same time, and they have no reason to get a good price. They're going to sell it for 80. They're going to destroy our firm. It's a great firm. They're great bonds. There's nothing wrong here. We just don't have $400 million to pay them. So why don't you, we'll give you half the firm, just put up the $400 million. You'll get a great firm. Everything's, there's, just save our firm. You'll get richer yourself, and you're going to save everything. And then Warren Buffett says, well, what if I don't do it, what's going to happen? My cousin says, they're going to sell, we're all on the phone listening, we're going to sell the bonds on Tuesday. They're going to sell the bonds that are worth 100. They're going to sell them all for 80, and it's going to destroy our firm. And so Warren Buffett says, you want me to make the margin call today so you won't have to sell the bonds? He says, yes, that's what we want. And Warren Buffett says, I think I'll wait till Tuesday and buy the bonds at 80. So, all right, so my cousin then calls all these people up and says, we're going to sell them ourselves on Monday. So you have the weekend. Here are all the bonds. We have three. Here are all the bonds we're going to sell, all the tranches we're going to sell. You can study them, spend the whole weekend figuring them out. So all these guys are on vacation, fly back from their vacations thinking they're going to make a huge amount of money. And so Monday morning comes, and we sell the first third of the bonds. Now, they've all come there. One guy came from Budapest, where he was on his honeymoon even. So he comes back. They all come back. So what do you think they're going to bid the first day? It's an electronic bid. So for all the first third of the bonds, so we sold them at 10 a.m., 12 a.m., and 2 p.m. So at 10 a.m., they have to make all the bids on the first third of the bonds. They all bid 80, 81, 82. They know if they bid below 80, then we won't even be able to pay back our lenders. So of course we're not going to be able to accept that. But they bid 81 or 82. And so he said, my gosh, we're going to lose all our money. We're broke. And we're sitting there wringing our hands, my cousin says. We're going to send them all back an email saying they were outbid. So everybody who makes their bid at 81, they electronically make their bid. We electronically say back, sorry, someone bid more than you. That was us. But anyway, so then we wait till 12. We don't know what's going to happen at 12. Are they going to bid 81 again? Now these guys have come. One guy from Budapest had come all this way, hasn't bought anything. So we don't know how it's going to go. But anyway, so we're waiting at 12. They're all bidding 95. So we start selling at 95, and then the third wave at 2, they're all bidding 99. So we lost a bunch of stuff at 95. So so a third of them sold at 95 and a third of them sold at 99, and it was enough to save us. So we were celebrating. Now there was more adventures that happened here because I'm taking too long, so I'm not going to finish the story. So they bought it on a holiday Monday. There's someone named a prime broker. The job of the prime broker is to. So when you buy something, like Ellington buying something, you do it with borrowed money, and you leave the thing you bought as collateral with the lender. So we don't actually have in our physical possession any of the bonds we bought. So the prime broker, the job of the prime broker, which is some very rich investment bank, is to say, you can trust these guys, don't worry, the piece is coming, they have to get it from the lender, and then they'll eventually give you the piece that you've paid for. We vouch for it, you can count on us that it'll get delivered, otherwise we'll give you back all your money. So they trust the rich prime broker. So the next day, Wednesday, all these guys are calling us and they're saying, we haven't gotten our money and the prime broker has refused to vouch for you. And we said, what are you doing, prime broker? And they said, well, you did it on a holiday and we don't know what's going on. We can't keep all the records. And so we nearly had another mess. But anyway, we got through that too, and that's another long story, but pretty interesting. But this was, twice in a row, something terrible had happened involving collateral and involving margin calls. So I figured, it can't be all my fault. There has to be an explanation And not an explanation just applies to a little hedge fund, but an explanation that applies maybe to the whole economy. And so I wrote a paper in 97 on collateral equilibrium. You know, the Kidder Peabody went out of business in 94. By the time it was published, it was 97. And then this experience was actually 98, but I call it the leverage cycle. Okay, and then, so that's the theory I'm going to tell you that explains the 2008 crisis. So we had another disaster in 2007 and 2008, where again we almost went out of business, but again we survived. And again, the years right after the crisis were always the most profitable years. The new thing I learned in 2008 was that, I'm going to talk about this in the talk, was that sometimes when people owe so much, the homeowners in this case owe so much, it's impossible for them to pay back. You can get more money out of them by forgiving part of what they owe. If they owe 100 and they can't possibly pay it, they're going to give up and pay nothing. If you tell them, okay, we know you can't pay it, just give us 50, you can get the 50 out of them. So you get 50 back instead of losing everything. So it's good business for the lender as well as the borrower to forgive when things are sufficiently bad. And so that I realized in the mortgage market in 2008. So anyway, I'm going to now retell the whole story in a model instead of just anecdotally. And I'm trying to persuade you that this applies to the whole economy. Okay, so now what is collateral? Collateral is an asset that backs a promise. So if the collateral is worth 100 and the promise is 80, the collateral is always worth more than the promise, so the lender feels protected. 80% loan on a $100 asset is called 80% loan to value. Okay? Another way of saying it is 20% is the cash you pay, that's the margin. Sometimes people call it the haircut, but anyway, the margin is 20%. And $20 allows you to buy a $100 home or a $100 asset for only $20 of cash. So leverage is 5 to 1 because with $20 of cash you buy a $100 asset. So those are all say the same thing, with different ways of looking at it the same way. So leverage is 100 to 20, 5. Okay, now what is my theory of why these crises happen and why they can happen on a whole economy? Okay, so of course, my cousin and all these other business guys were used to little crises like this. So they knew that margin calls were bad and leverage was a dangerous thing. I'll talk about it in a second. But they didn't have a theory of macroeconomics. So that's what I contributed. So here's my idea. So in the economy, there's typically a ratio, like think of houses, where you can borrow 80% of the value of the house. And things go along that way. The asset's worth 100, the borrowing is 80, that's 80% loan to value. Then people begin to feel so safe, and the lenders don't get worried anymore because the housing prices never seem to go down, so they start letting you borrow more and more, maybe 90%, maybe 95%, maybe 97%. So that makes borrowing go up. But the crucial idea is that when everybody can borrow so much, you can buy a house now, a $100,000 house, but with only $3,000 of cash. So of course more people are going to try and buy houses. And the price of housing is going to go up. That was the insight. So now you used to borrow 80% of a $100 house. Now you can buy a higher percentage of a higher price. So borrowing has gone way up in the economy. 2 reasons: higher percentage of a higher price. Now, suppose something bad happens to housing, some news about housing that makes it not so good, or maybe the economy is doing a little worse and homeowners, can't afford to, the young homeowners can't buy new houses anymore, so the price of housing starts to go down. Well, that means that people start to lose. They owe more than the house is worth. A lot of people start to lose money who borrowed a lot to buy the houses. So that puts them in danger. But more than that, worse than that, so because the best buyers of houses might have to sell the house to try and pay off their mortgages, or the houses get claimed because they've defaulted on the mortgages, the price of housing starts to go down again. But then the second thing is, because the lenders see the price of housing going down and fluctuating, now they're nervous. Before they weren't nervous at all. So every new buyer, instead of being able to borrow 97% or even the old 80%, now they can only borrow 50%. So every time a house gets sold, the new buyers can't borrow almost any money to buy the house. So the house goes down again. Okay, so 3 reasons. It's bad news, the people most interested in buying were the ones who are betting and leveraging, and so they lose more money, and the new loan to value gets much lower. All those things drive the price of housing way down. That's what causes the crash. And now when you have the debt that's way up here and the prices of collateral way down here, you know you're never going to get the money, because what's owed is so much more valuable than what the people have to pay that you'll never get the money. So instead of just forcing them to default and ruin their houses, you should forgive part of the debt down to there and make more money for everybody. So that's going to be that's my theory. Okay, and this is very different. You see, it all involves loan to value and leverage, very different from the standard, the interest rate explains everything. The typical story in macroeconomics is all about the interest rate and not about leverage. I mean, it's changing now, but the old story was all about interest rates. So the real story is about volatility and feeling safe and leverage going up and down. That's what my theme is going to be. So now, I don't actually think that it seems, the theory is almost common sense. And so so I tried to figure out who had this theory before me. And so the first one that I can see was Shakespeare. So Shakespeare's supposed to be a famous, writer, psychologist. He's also a great economist. And so his father, was mayor of his little town. And Shakespeare himself, it was about Shakespeare. Shakespeare was a great businessman. I mean, remember, he borrowed money to buy the Globe Theater. And so he ran this troupe, and he had to, borrow a lot of money and do a big investment and run a lot of risk and have all these expenses. And so he was keeping track of, finance was very important to him. And his father was actually tried for lending at too high an interest rate. So anti-usury. So Shakespeare all his life was thinking about money and lending and stuff like that. So why is it that we don't think of Shakespeare as an economist? Well, he wrote a play about economics, The Merchant of Venice, which when I was in high school everybody read, but nobody seems to read anymore. And I think I know why they don't read it anymore. It's not even regarded as a very good play anymore. I think it's a great play. So I'm going to tell you the story of The Merchant. Have any of you read The Merchant of Venice? See, nobody's read The Merchant of Venice. Oh, here are our well-educated professors sitting in the front. Okay, but that's the older generation. So the new generation, it's regarded as partly as a comedy and partly as a commentary on anti-Semitism. And people are very uncomfortable with anti-Semitism, and so instead don't read the play at all. So I think that that's actually an important part of the play, but the really important part of the play is about economics. So I'm going to tell you the story of The Merchant of Venice. So this guy named Bassanio wants to marry this woman named Portia. And the first thing you're told about Portia is not that she's beautiful, but she's rich. So Bassanio wants to marry the rich Portia. And unfortunately, he's in Venice, and she lives off in some island or something, I've forgotten where. And, it's very expensive to go there, and he has to bring all these gifts and stuff like that. And so he doesn't have enough money. So he figures he's going to make an investment. He needs to borrow some money. So he goes to Antonio, who's the merchant of Venice. He says to Antonio, "Can I borrow the money?" And Antonio says, "I don't have enough money, And so, but Shylock, Jewish money lender, he's got the money. So they go to Shylock and they say, we need to borrow the money. And then they have a debate about what the rate of interest is. And so this is the anti-Semitism part. The Antonio, who does all the talking, says, "You're not going to charge us interest. I mean, that's disgusting. No Christian would charge interest." And Shylock says, "Listen, you idiot, you'd never get anybody to lend you money if there wasn't interest. And so you are impatient. You need the money right away. I don't need the money right away. That's why I'm willing to wait and lend you the money. But of course, I'm not going to do it unless I get interest back. So how can you possibly think that I'm not going to ask for interest?" So it's this long discussion of interest where Shylock is, Shakespeare is 300 years ahead of his time. He's understood that interest depends on impatience, and Shylock has understood all that, and Bassanio and Antonio are these sort of Christian fanatics who don't quite get it, but also, of course, it's to their advantage not to understand because they don't want to pay interest. So then at the end of the negotiation, Shylock says, by the way, I need collateral. And so what does the collateral turn out to be? Well, they try to talk about the collateral. It's a pound of flesh. So, and Bassanio agrees to put up a pound, or Antonio actually agrees to put up a pound of flesh as collateral to be taken from wherever Shylock wants. And so after the play ends, after anybody reads the play, they're so gripped by the pound of flesh that all they can remember is the collateral. So I saw the play in New York about 3 years ago, and a very famous actor, what's his name? He played Michael Corleone.
Al Pacino.
Al Pacino. Al Pacino played Shylock, and he just did brilliantly as Shylock. And the crowd in New York was riveted by his performance. And so as people left the theater, I would ask them as an experiment, do you remember what interest rate that Shylock finally agreed on and with Bassanio? And not a single one could remember the interest rate. I talked to Yale's greatest Shakespeare scholar, Harold Bloom. Some of you may have heard him. He's one of the great scholars in the world, and Shakespeare is his specialty. And he has a photographic memory. He's famous for remembering everything I said. And he gave a lecture. I went to hear his lecture on The Merchant of Venice, and then I asked him afterwards, by the way, can you tell me what interest Shylock charged Bassanio? And he said, dear boy, I remember almost everything, but actually I've forgotten. So no one can remember the rate of interest, but they all remember the collateral. So Shakespeare made it so unimportant and so quickly that he went over the rate of interest because he wanted everyone to concentrate on the collateral. So he understood from the very beginning that collateral is more important than interest. Leverage is more important than interest. And that's the first message of the play. So then what happens in the play is Shylock, the ships. Okay, so by the way, the play begins, every Shakespeare play begins by announcing in the first lines the purpose of the play. And I don't know why they're not taught this way. But this one begins with Antonio walking on stage, and he says, oh, I don't know why I'm so depressed. In sooth, I don't know why I'm so melancholy. And so the little guy talking to him says, well, I can see why you'd be nervous. I mean, you've got all your money's invested in ships that are traveling, and it must be very scary. And Antonio says, I'm not worried about that. Every ship is on a different ocean, so I'm not worried. And then the guy says, well, you must be worried about love. And he said, no, I'm not worried about love. So the very opening of the play says it's a play about economics and not love. Love's second, economics is first. And also Shakespeare understands diversification. So he's announced at the beginning what it's about. So anyway, all those ships apparently sink, and so Antonio can't pay the 3,000 ducats back. So what happens is they go to court, and Antonio demands Shylock demands his money. Now meanwhile, Bassanio has gone to the little island to woo Portia, and Portia has, so Portia says, to woo me you have to go through a very elaborate thing. My father, who was very rich, that's why I'm rich, he just died, and he said you have to pick a casket, a gold, a silver, or a lead casket. If you pick the casket with my name in it, you get me and I marry you. If you pick the wrong casket, not only don't you get me, but you have to swear never to marry anybody else. So all the people choosing the casket say, this is just incredibly risky. I mean, I'm not only going to lose Portia, I'll never be able to marry. So of course they give long speeches about risk and return, another thing Shakespeare understands. So Bassanio picks the right casket. He's marrying Portia, who remember is incredibly rich. And so Bassanio hears what's happening to Antonio in the ships, and he rushes back to try to help his friend. Meanwhile, Portia is much more clever than Bassanio, and it's all a comedy about how smart Portia is and how bumbling Bassanio seems to be. But of course, that's not what I believe. Anyway, that's why it's supposed to be a comedy and about love. Anyway, Portia goes to the judge, and she's very rich, and she says, listen, let me be the judge. And so she shows up disguised as the judge. Nobody knows it's her. And so then they come to the trial with Portia disguised as the judge. Shylock says, we had a contract. They owe me the money, and they didn't give it to me, so now I'm entitled to my pound of flesh. And so Portia, the judge, says, you're right. The only reason contracts mean anything, and the reason why Venice is the center of commerce, is because we enforce contracts. And there seems to be no doubt that you've agreed to this contract. And Shylock says, absolutely, I want my pound of flesh. And then she says, then Bassanio jumps up and says, listen, I've got 3,000 ducats. In fact, I've got 12,000 ducats. Take these ducats. It may be late that we paid you, but here are my, you can get paid back. So Shylock says, no, that's not the contract. You were supposed to pay by this time. You haven't paid yet. I want my money right now. So Portia says, Shylock, show mercy. Don't you know that mercy is it droppeth from the heavens like rain, and it helps him who gives. It not only helps him who receives the mercy, but him who gives the mercy. But Shylock is so angry at Antonio and Bassanio because they kind of made fun of him and insulted him in the negotiation. Then his daughter went off and married a friend of Bassanio's and left him, and in fact stole some of his money, and he's just enraged. And so he says, no, I want the contract. You say your estate depends on enforcing contracts, enforce the contract. So then basically Portia says, I'm sorry, in this stage it's so important sometimes the magistrate has to intervene, and really maybe you think you agreed to a pound of flesh, but that's not the right kind of contract you should have entered into. It should have been a pound of flesh but not a drop of blood. And so Shylock can't get his money, and so he's completely ruined. So that's the end of the play, and everybody's celebrating. You would have thought it would end there. But it doesn't quite end there, because Bassanio then goes up to Portia, not realizing who she is. And she says, oh, wise judge, what a brilliant decision. I'm so pleased with you. Can I reward you? Because he now thinks he has all this money, which is actually her money. But anyway, can I reward you? And she says, I don't want to reward. He says, no, please, I want to reward you. And she says, what about that ring? And he says, I can't give you that ring. That's the ring my wife, who I just married, gave me. And I swore that I would never, till I died, part with this ring. I can't give you this ring. And she says, do you want to reward me or not? And he says, oh my God, what am I going to do? And so he takes the ring off and gives it to her. And so then it turns out his servant, who also married her servant and also got a ring, her servant that asked him for his ring, and he gives them her ring too. So both of them give up their rings, and so it's supposed to be a comedy about what fools they were. And in the explanation of the play that Harold Bloom gave, he says, Bassanio's such a fool. After 6 months, Portia's surely going to divorce him. But when he goes back to find Portia, finally, after the whole thing's over, Portia's back in her home, and he doesn't know she's been the judge, and they're kissing each other and everything, and then she says, Bassanio, I don't see your ring. And he says, oh, I had to give it up. And so they have this discussion, and she forgives him. And so the point is, when something so unexpected and so important happens, you can't always keep your promise. Of course he should reward the judge by giving the ring, because that was nothing either of them ever anticipated, and it was far more important and pressing than the original promise. And so he ends up with Portia, he ends up with the fortune, his friend gets saved. And so who's the fool? Not Bassanio. He's the best investor in the entire story, and it's a story about good investing. The play ends with Portia giving him the ring back and saying, swear again that you'll never give it up. And Antonio says, I guarantee that he'll never give it up. I put myself up as collateral again. So it ends the way it begins, with promises and collateral and stuff. But you're supposed to break your promises when you have to. Okay, so that's the story. So this whole story, which Shakespeare already had, seems to me completely like common sense, and yet its major implications haven't been accepted. So let me just repeat what the theory is. In the standard theory, supply and demand for loans determine the interest rate, and the interest rate is the whole key. Okay, but in this theory, equilibrium, in my theory, equilibrium is supposed to determine leverage, how much you can borrow, as well as what the interest rate is. But how can one supply equals demand equation determine two variables, the leverage and the interest? That's the point of the theory. So I'm not going to explain how that happens, but basically through some mathematics, what happens is the interest rates depend on impatience, just like Shakespeare and Shylock understood 300 or 400 years ago by now, 300 years later, the economists understood it. Irving Fisher, but 400 years, okay, so it's 300 years ahead of their time. Impatience determines the rate of interest, but leverage is determined by how safe the lenders feel. The more volatile the world is, the more dangerous it is, and the more lenders feel at risk, and the less loan to value they'll give. Another thing that increases leverage, by the way, all the time is financial innovation, because there's always a shortage of collateral. People always want to borrow, and they don't have enough things to put up as collateral. So Wall Street and the rest of the financial world, they invent ways of stretching the collateral. Like my cousin using houses as collateral for mortgages, and mortgages as collateral for pools, and pools as collateral for tranches, and tranches as collateral for purchases. The same house, backed up 5 different promises. So you stretch the available collateral as far as possible, and that's always going to, in the end, increase leverage. So leverage is always going to be going up unless it's restrained. So now, why is leverage so important? As I said, every business person knows if you have a $100 house and you borrow $80 and the house goes down by 1, so you're 5-to-1 leverage, $20 turned into $100. If the house goes down to 99, okay, and then you have to sell the house, you now pay back the 80 and you've got 19 left. So although the house only went down 1%, you lost $1 out of your 20, so you lost 5% of your money. The 80 was the borrowed money. You only put down 20. So because you were 5 times leveraged, you lost 5 times the amount of the decline in the asset value. So the typical bank in 2006 was 30 times leveraged. So that meant if the houses went down 3%, whatever was backing their borrowing, whatever they put up as collateral, they'd lose almost all their money. So that's why it's so dangerous to be leveraged, is because it multiplies the risk. Okay, but as I said, for me, the real significant, so every business person knows that. What I contributed was to say that leverage changes the price of the thing backing it. If enough people can leverage, the houses are going to go up in value, everything's going to go up in value. Okay, so more leverage means higher prices of the collateral, low leverage, less prices. So why is that? Well, it's this common sense idea that if you think of people, the most optimistic, the people who want to buy the most, to the least, the people who want to buy the least, what's going to happen? Whatever the price is, some people, there's going to be someone who thinks it's a fair price. So the people who like it more are going to be the buyers, and the people who like it less are going to be the sellers. So the price always corresponds to the value of the marginal buyer. Now, what happens when leverage goes up? When leverage goes up, the buyers can buy more because they don't need as much cash. They can borrow most of the money. So you don't need as many buyers to buy everything. So that means this area shrinks, which means the marginal buyer becomes a higher person. But if the marginal buyer is a higher person, that means, because his valuation always corresponds to the price, that means the price is higher. Okay? Or, it's common sense. So the more you can leverage, the more the price will go up. That's because the people who are selling, leverage doesn't affect them. They're just selling the piece. So extra leverage gives these people more bargaining power, or more buying power, and doesn't do anything to the rest of the people. So you're going to have a higher price. Okay? So, and this reason why people are different, this depends on heterogeneity. One of the problems of macroeconomics for many years, it's all changing now, is that they used to have a representative agent. This depends on having different kinds of people, some who like the asset, some who don't like the asset. That's why more leverage has such a big effect, because it affects some people who want to buy, they're going to use the leverage. The people who want to sell, leverage is irrelevant to them. So that's why the price goes up. It depends on heterogeneity, and there are many reasons why people are heterogeneous. Some people are more risk tolerant. Some people like living in houses. Some people are more sophisticated. They can buy these complicated tranches. Some people may be just more optimistic. There are many reasons for heterogeneity. So the crash has 3 phases. Price is going up, crashing, and the aftermath. So I already described the going up part. The volatility is low, leverage goes up, the asset prices go up. And when they're high, by the way, that's when everybody feels their best. Everyone's feeling rich. Everything's been going well. It seems like things couldn't be better. And usually volatility is very low at that point. So all the signs that people typically looked at, like volatility and asset prices, to be signs of a good economy, that's actually turns out to be the most dangerous point of the economy, not the best point of the economy. So then what happens? There's bad news, which, as I said, makes everybody, forgot which way I did this, everyone values the asset less. If it's scary bad news and makes people think that the world's volatile, then no one will be able to borrow. They have to deleverage, and the new buyers can't buy. And then the people who are leveraged the most. Remember, if you're 5 times leveraged or 30 times leveraged, you lose 30 times the amount of money. So the people losing the money are the best buyers, the ones who most wanted the good. That's why they leverage the most. They're the ones who lose the most money when it goes down in value. So you wipe out the best buyers, the new buyers can't borrow as much, and the bad news itself is bad for the assets. So the bad news may have been very small compared to the no borrowing again and the wiping out of the money of the leveraged buyers. So a little cause can have a big effect because it goes through those other magnifying things. So here you've got a world where everybody's feels safe with low volatility, high asset prices. Maybe things get even better. That's what they're expecting. But with some small chance, things might get much worse. And then you have this big collapse because volatility goes up. If it's bad news, it's also scary. It makes volatility higher and makes the lenders want to lend less. Okay, so as I said, you started off with the marginal buyer, buying these guys. Then you got bad news that wipes out all the original buyers because they're so leveraged, they lose a huge amount of money. So now you've got the rest of the population that has to buy the same assets. Well, you've lost your best buyers, and now you're going to have, this is the top now, you're going to have a new marginal buyer. But the new marginal buyer is going to have to be way below, this gap is going to be much bigger than that gap, because here you could borrow by leveraging. So a few people could buy all the assets because they could borrow so much. Now they're gone, and the people under them don't like the asset as much, but also you need a lot more of them because they can't borrow as much to buy the asset. So the marginal buyer goes from here, not just down to here, equal, but all the way down to here. Okay, so you've got the drop in price then comes not just from the bad news, but mostly because the marginal buyer went so far down. And this guy had a much lower opinion than that guy of the same assets. So that's the theory of the leverage cycle. Then in the aftermath, you've got so many people underwater. Now what happens when you're underwater? If you have a house that you borrowed $80,000 on because it was a $100,000 house, but now the house is only worth $50,000, and you're going to lose your house eventually. First of all, why should you owe 80 and the house is only worth 50. You're probably going to default eventually, but while you're staying in the house, suppose you could fix it up for $10,000, okay, and maybe make it worth 50. Why would you pay $10,000 to make $50,000 of improvements if they're going to take the house from you anyway? Actually, in this case, I better have a bigger gap. Suppose it's worth $200,000. You owe $200,000. The house only worth $100,000. Why spend $10,000 to improve the house value to $150,000? You're going to lose the house anyway. It's still not going to be worth what you owe, so you're not going to do it. So nobody makes improvements in the economy once they're underwater because it's not worth it to them. So you now have everything going to hell. So in the housing market in the US, people who are underwater, it took them 3 years to kick these people out of their houses. So for 3 years, they weren't paying their mortgages, they weren't paying their taxes on their houses, they weren't fixing up the house. And so and then once you finally kicked them out of their house, you had to hire a real estate agent and stuff. So it turned out that the typical lender who threw someone out of their house got back 25% of the loan amount. Okay, so if the loan was 100, in this example, suppose the loan is $100,000 and you could have forgiven the loan down to $90,000, okay, but instead you throw the guy out of the house, you'll end up getting under $50,000, okay? So you get a lot less money by throwing somebody out of the house, forgiving part of the loan and getting that. And you know that the guy's going to pay you back once you make the loan below the house value. He's going to pay you back because it's in his interest to pay you back. Either he's going to pay you back and keep his house, or he's going to find a way to sell the house and make a profit on the difference. You forgive down to below what the house is worth. Then he's going to either pay you back or he's going to sell the house, pay you back, and keep the difference. Instead, you let him stay in the house for free and destroy the house, and you end up getting under 25% back. So it's a complete catastrophe in America, the subprime mortgage market. 8 million households got thrown out of their houses. That's 3 people to a household, 3 or 4 people to a household. 20 to 30 million people were tossed out of their houses during the mortgage crisis. None of that could have happened if we had forgiven some of the debt. Okay, so I'm just repeating myself. So, I claim this kind of leverage cycle, there's the tulip bulb craze in Holland where people bought tulips. You've probably heard of this story, for, today, little flowers for thousands of dollars. They weren't paying in cash for that. That was all being borrowed. And the land boom in the 20s in Florida was all being borrowed. In Japan, the land boom in the 80s to 90s. The gardens around the Imperial Palace were worth more than California. You think someone paid cash for those? No, they did it all on borrowed money. So everything happens with this leverage. So if you look at this hedge fund that my cousin and I started, my cousin really started, had we went out of business in Kidder Peabody in 94, remember, and then we had this crisis in 98 where we got the margin call. So since that point, we kept track for everything we bought what the loan to value was. Okay, so or the down payment. So 10 means 10% down payment or 90% loan to value. So the blue line is the loan to value on this portfolio of loans. We always keep this representative sample of mortgages and we ask, if we wanted to borrow using those things as collateral, how much could we borrow? So the average of those things, here you can see was 90%. We could borrow 90%. Then in the crisis of 1998, suddenly we could only borrow 60%. It went 4 times the down payment went up. And then after a few months, it went back to 10% and stayed there. So this was such a short-lived event in America that nobody paid any attention to it. Our crisis in Ellington. I paid attention to it because I almost went out of, we almost went out of business. And so it was really frightening. So that's why I took it so seriously. Everybody else said, oh, these lenders were crazy. For no reason they changed the margins and then very soon they went back to what they were before. It's just irrational lenders. In economics, it's very dangerous ever to think that people are irrational. It's fashionable nowadays, especially, to say irrational, irrational, irrational. But people, when it's a lot of money at stake, they tend to think about what they're doing. So these lenders, they were doing this for a good reason. They were nervous that people were going to default. There was the Asian crisis in 98. Anyway, I won't go through all the explanations. So I thought this was going to happen again and would have a huge effect. So here we go with the margins, the blue line at 10%. Then they go to 5%. So now you could leverage 20 to 1. Okay, and then all of a sudden in 2007, everybody gets nervous again, and look at what happens to the margins. Now you can only borrow 70%, 30% down payment. And so what happened to the prices? They also crashed the same way. In fact, this graph ended in 2009. So this is the graph I gave to the Federal Reserve in America, which never kept track of any of the down payments. They literally had none of this data. I talked to Bernanke, who'd been my exact class. He was at MIT when I was at Harvard, but we're in the same class, and so we saw each other all the time. So how could you possibly not keep this data? I said to him, and he said, well, you have to pay $200,000 a year to get all this data, and the Fed didn't think it was worth it. So anyway, they didn't have any of this data. So now they're getting the data. Okay, but not in 2009. Okay, now they're doing it, and now they can do it better than anybody else. So now I just continue this graph. So this is the same graph, and this is where it ended. Okay, and now you continue it till now. You see that the leverage has gone back up, and so have the leverage is blue now, and so have the prices gone back up. So it's not only that they showed the crash, also they go exact together. And the rebound. And so leverage is much higher than it was during the crash, but still not up to where it was before, and neither are the prices. Okay? So and if you look at housing, it's the same thing. My colleague, Bob Schiller, who just won the Nobel Prize, partly won it for creating this index of housing prices and showing this big boom and this big crash in housing. And we used to give lectures together, and he'd start off by saying irrational exuberance. For no reason people thought things were going to go up, and they were so optimistic, and they kept talking to each other, and each guy would say, oh, I just made money on my house, and the next neighbor would say, well, let me do the same thing, I'll buy another house. And then, when things were so high, they started saying to each other, things can't keep going like this has got to change someday. And then, there's one cocktail party after another where people say things are going to change. They started selling their houses, everything goes down. Well, that's probably had a lot to do with it, but another explanation is if you look at the average down payment, same thing as before, on a house, it was 14% in 2000. So that's 7 times leverage. And then the average down payment for the top 50% of people, some people hardly borrow anything, so I ignore those. The top 50%, what is their down payment? The average in 2006, second quarter, was 2.7%. That's 35 times leveraged. And that maximum comes in the same month, same quarter as the maximum housing prices. And then leverage goes way down and housing prices go down. Okay, so that's so if you look, now this is something that the Bank of San Francisco did. If you look across the world, in 1997 to 2007, you look at the debt to people's income. It's a little different. It's not leveraged asset value, house value to its income now, but it's a similar idea. Income to how much they borrow. You see a lot of countries, like Italy, went up a reasonable amount. You look at Ireland, look how much the debt to income soared from 97 to 2007. Norway, it soared. The US, it went way up. England went way up. Spain went dramatically up. 2 countries where it didn't go up at all are Germany and Japan, okay, where loan leverage went down in those 2 countries in that decade. Now you look at what happened to housing prices, okay, and you see here's Ireland, Denmark, the Netherlands, okay, that's where here's leverage, and here's the change in housing prices. So the people who leveraged the most had the housing prices go up the most. People who didn't leverage at all, housing prices didn't go up at all, Germany and Japan. So it's true across the country. If you look at who lost, who consumed less, where was the biggest drop in consumption after the crash? It's again, the Bank of San Francisco. It's the same people, the Netherlands, Ireland, Denmark, Portugal, and the ones here. Germany didn't lose anything, and Japan almost nothing. Okay, so... all right, so what was the bad news? I'll end with one thing. What was the bad news that triggered the little bit of scary bad news that created the crisis? You know, in macroeconomics, there are always these shocks. You know, shock happened. You never have to actually say what the shock was. Well, I'll tell you what the shock was. So here, you know, leverage is going up, 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 and it stops going up. Now that's not a shock. You know, it can't get more than 0% down payment. People aren't going to pay you to buy a house. You have to pay them to buy the house. So obviously things were going to sort of reach a maximum here. The question is why they started going down. So the macroeconomists went down. Okay, but why did housing prices go down? That's the thing you have to explain, not the thing you take as exogenous. That's the key to the whole economy. Why did housing prices go down? Why did leverage go down? Well, the piece of bad news was that in 2007, there was a sudden decline in the subprime mortgage market. Okay, so this is the index of BBB subprime loans. That's risky loans. And, you know, things were going at 100, no danger, and suddenly in the beginning of 2007, they crashed. So why did they crash? What was the piece of bad news? Well, if you look at these borrowers, so here's Countrywide, it's the biggest lender to subprime borrowers on houses. Subprime means they're not the best borrowers, so they have bad credit ratings. They're lending their delinquencies. So this is 2003 vintage. You see, when they first get the loans, nobody goes delinquent, and it gets to around 2%. Some people get thrown out of their houses, so the people still actively delinquent, it's always around 2%. Okay, and the next vintage, 2%. Well, then the 2005 vintage went up to 5%. So here's January 2007. And the 2006 vintage, which was very new, was already in 2007 up at 3 or 4%. Now, 5% delinquent is nothing. Those people are going to be, first of all, they may end up paying eventually. And if they don't pay and you throw them out of their house, you know, if you get back, the house is worth 100 and the loan is 95, you know, how much you're not going to lose anyway because you've got the house to sell. The housing prices haven't gone down much. So there's no expected losses. There are no losses yet. It's just delinquency's gone up a little bit. Well, the market, which isn't so crazy, they began to realize that maybe the delinquencies are going to be much higher than they've been in the past. Maybe we lent to just too many people who are, you know, and so the market for these BBB pieces, that's the riskiest part of the lender's lending. That part's the ones that went down. And so that was the trigger. So if now the buyers of the pools, You know, this is the bonds created by the pools, the tranches on the pools. If those prices have gone down, it's going to be harder to sell things into a pool. So what would you do if you were a rational bank trying to sell into a pool? You'd ask for more collateral to sell the next loans into a pool. And that's why the leverage went way down, because now it was more dangerous, and the lenders, in order to sell into the pools, had to say to the pool guys, buyers, look, these homeowners have more collateral than they used to have, so you should continue buying the pools. All right, so that was the trigger for the crisis, and that's what set the whole thing up. The basic idea is you get more nervous, something happens, leverage dramatically changes, that dramatically changes the asset prices, and then you have this cascade of problems, and then you get left in a situation where so many people are so far in debt that they'll never pay it back. Maybe I'll show my last picture of the debt. And so what did we do in America? What was our plan to save the homeowners? The Obama administration did the same thing that the Germans are doing in Greece. They said, let's go to these homeowners and tell them we'll lower their interest rates a little bit. Okay, so they shouldn't feel so bad. We'll delay what they owe us. We'll make them pay a smaller interest rate, or they don't even have to pay it all for a little while, and what they don't pay will add to the principal. And that'll get them through the bad times. So this is the cumulative recidivism, that's redefaulting. So what happens is, after 18 months, 80% of the people who got their interest rates reduced defaulted again, okay, depending on what new interest rate they paid. So even the people down to 2% new coupon, 50% of them redefaulted after 18 months. So just lowering the interest rate for a little while didn't solve the problem of the indebted homeowner. In the end, the lenders lost much more money than they had to if they had just forgiven part of the loan. So it was crazy for the lenders, crazy for the borrowers, and that doesn't even take into account how much better the economy would have been if all those people stayed in their homes instead of been thrown out.
One question regarding the crisis,
Yes.
in the sense that what was the role of the interest rates increases by the Fed on the increase in delinquencies? Because in some sense, you have very low rates, and then rates start to increase by 2006, I think.
Yes.
And then delinquencies start to increase. So there's a link there between monetary policy and delinquencies that.
Where's my picture? Okay.
And the second one is how different is this idea of leverage cycle when you introduce the liability dollarization, and our case in particular.
Okay, let's try the first one. So the way most of these loans, subprime borrower is a guy with a bad credit rating. So what did the typical subprime loan look like? For the first 2 years, what you would do is you would pay a very low interest rate, and then so it would be LIBOR plus a little bit, and then at the end of your second year, you weren't allowed to refinance it, and then at the end of your second year, the rate would suddenly jump up by 5% after you had a chance to refinance. And the rate would jump up 5% above LIBOR, which is the London Interbank interest rate. So why did the interest rate, why did the loan look that way? Well, the reason is that these people who are subprime borrowers, a lot of them had bad credit ratings because they were young. They were in college and they didn't pay their credit cards on time. And they were finally buying their first house. So after they paid for 2 years and made every payment for 2 years, they would look like good borrowers, and so they would be able to refinance their loan, which was going to jump up in interest. They'd be able to refinance it into a prime loan with a low interest rate. So all the good guys would do that, and all the bad guys who the prime lenders would say, you didn't even pay your mortgage during those first 2 years. You had a bad credit rating to begin with, and you're a lousy payer on your home. We're not going to give you a prime loan. So those guys are a huge risk, and so they would be charged. They would have revealed themselves to be even worse than the typical subprime borrower. They had to pay a higher interest rate. Okay, so that was the way the subprime market worked. So 70% of the subprime borrowers defaulted within a month of the 2-year point. So if you were a lender to these subprime borrowers, you knew you would get 70% of your money back right away. So now if the interest rates go up, that means when the money jumps, when the interest rate jumps, it's only affecting the people who couldn't refinance anyway, who are bad homeowners to begin with. Okay, so you didn't start to see anything going wrong. Well, here it's starting to go wrong. Maybe this is already a sign of something going wrong. In January of 2006, this is when the interest rates started going up. Bernanke started raising the interest rates right here. So you're trying to say all this delinquency is just because these subprime borrowers were subject to pay a higher interest rate, that they all started not paying it. And what I'm saying is that I don't think that maybe that had something to do with it. Actually, this needs to be studied a little more. But I'm saying there are very few of these guys anyway, because everybody else is either in their, they're still in there. So how many people could possibly be in this range? Remember that 70% of them are refinancing immediately, so they're not paying the higher interest rate anyhow. So you've only got the 30% who are jumping, and it's the 30% of the few people whose 2-year period has just ended. So you've got a very small number of people who are being affected by this change in interest rates, and it didn't last very long, because I forgot when, in 2007 or 8, Bernanke lowered the interest rates to 0. So for the vast majority of these guys, they never had to pay the higher interest rates. But anyway, so your conjecture is that some of this rise in delinquency came because of the rise in interest rates. So that's a good point. I don't think it's true, because there are not enough people to matter. And it was the people who couldn't, the real reason for the big delinquencies was that the end of the second year, the people, so I'll tell you another number. So as I said, all through this period, 70% of all subprime homeowners, within a few months of the 2-year expiration of the no prepayment thing, they would refinance. Okay? And that number dropped from 70% to close to 0. So that drop of 70% refinancing to 0 refinancing, that I think is much more important than whether the 30% are already terrible anyway, whether paying a higher interest rate was affecting them. But it's a good question you're asking, so I should look more into that. Okay, so if you have dollar-denominated debt, that's another. This, dollar-denominated debt, or if you take the case of Greece, euro-denominated debt, it makes the situation much worse, because you owe something that's, you owe something in euros, which has a fixed value, and everything in your economy is going down in value. The wages are all going down, the ability to pay is going down, and you still owe something that's fixed in euros, so it makes the situation much worse. This has been a very fashionable thing for people to write about. It's obviously very important. If you ask from an ex-ante perspective, knowing that if you got into a crash, owing dollar-denominated debt would make things even worse, shouldn't you always try to arrange to borrow in your own currency? So I actually wrote a paper about that, and everybody, this is now very famous. I don't know who the first person was, but it's very famous now to observe that if you owe money in dollars or in euros and your own economy collapses, that's very bad. If you're Uruguay and you can owe in the local currency, that's better, because your local currency is going to go down in value, so you won't owe as much in the crash. So it sounds like it's more prudent to owe money in your own currency. But then, from an ex-ante point of view, the lender doesn't like, getting money in your own currency. And so from the lender, it's not as good. The lender would rather get money in dollars. So if you look ex-ante and try to calculate from the beginning whether it's better to have dollar-denominated debt or local currency-denominated debt, it turns out it's not so obvious. In fact, it can be better to have dollar-denominated debt, even take into account that you get screwed in the crisis. So,
if I understand correctly, in your theory, your explanation of these facts, leverage and price of house play a key role, are pro-cyclical,
yep,
and add to the boom and to the boost.
Yes.
You very briefly mentioned in your presentation financial innovations.
Yes.
And when you talk about your cousin, there was a lot of talking about financial innovation, because he seems to be a very creative guy, no? In your in your formal theory, can you endogenize that? Is it possible to make financial innovation to play an active role in all these stories? I guess it must be very challenging, but I'm thinking in practical terms from the point of view of Gerardo, who just ran away, from the central bank, no? Because once you have passed a crisis, you think that you are ready for the next, you have learned, but then people in Wall Street are much more creative, and here in the Torre Gemelas is probably the same. So
yes. Okay. In my work and work I do with Anna, we take the financial innovation as exogenous. So you move from a situation of no financial innovation to more financial innovation to more financial innovation, and we take it as just exogenously happening. And then we look at the consequence of what's going to happen. So we have a little picture here where we think of, first there was this leverage which made prices go up. Okay, so you have little leverage, then leverage is going way up and the prices are going way up. Then you've got this tranching, like my cousin is doing, which is increasing effectively leverage even more. And then CDS, which are credit default swaps, that's another innovation which is bad for prices, makes things go down. So we take this series of innovations as something that's exogenous and look at the consequence. So you're asking, would it be better to have a theory to explain when these innovations come? It's very difficult to build such a theory, as it is in a theory of innovation even in your field. But what I do say is that we know which direction typically innovations come in. They come in a way to create more leverage. And what's the reason for that? There's a huge incentive to do it, because people always want to borrow. The amount of people want to borrow is way bigger than the amount of collateral that they can use. I mean, what can you use as collateral? You can use your house or you can use your car, practically nothing else in the whole economy. Maybe stocks you can use as collateral. So if you can take those collateral and make the most of them, you're going to be able to stretch them and get more borrowing. And there's a big incentive to do it. It's very profitable for Kidder Peabody and my cousin to have done that. You know, the prices that people pay for the pieces is much higher than the original pool. So by cutting the collateral up, you've made it more valuable collateral. Okay, so you know which direction the innovation is going to go in. So I think we can't say what the timing of the innovation is going to be. The reason my cousin could take off with all this creation of tranches was because of the personal computer. You could get all these, you know, in the research department, we had to create all these structures, and we had to do it all on computers and keep track of all these cash flows. And the salespeople had to understand how all the pieces worked and have sample cash flows. You could never have done it without a computer. So the creation of the personal computer is what enabled this tranching of mortgages. So the innovation happened for a technological reason outside of economics, but the impetus to do it was always there in economics. So I don't think it's so important to know the timing. We'll never be able to get the timing, but we always know the direction. You're going to create more and more tranching and more leverage. So the government has to intervene. The central bank, I never got to what the central bank should do. The central bank has to restrain leverage when it thinks it's coming too fast. And at the peak of the crisis, you always see these things called CDSs being created, which enable people to bet on the market going down. And so they're never traded at the beginning when they might have done some good to restrain prices from going up. They always get traded right at the top and allow people to bet on things going down. So there's an innovation that actually works. Also know in advance is going. So you need to restrain too quick innovation at the beginning, and when you're at a peak when people are really nervous, then you should restrain how much CDS trading they can do. And you'd like to encourage the CDS trading at the beginning and not just at the peak.
Why investors do not bail out that is, you say that houses were sold at 25%.
Yes.
Why
okay.
They don't...
Right. Okay, exactly. So let me repeat your question. So I got the question. It's a very good question. Okay, so he's saying, my story was, if you owe this amount and the house is only worth that amount, the homeowner is just going to say, forget it, I can't pay it, and is going to walk away. And then when you take the house, By the time you get it, and after all the damage that's being done, you're only going to get this amount. So better to forgive down to here and get a lot more. And he's saying, if that's such a good idea, why didn't the market do it? Okay, exactly the right question. So I didn't have time to explain this, but let me now explain that. So the reason is, so I testified in Congress 3 times about this. So who owned all these bonds? They were hedge funds like Ellington Capital Management. So all the hedge funds said, this is terrible. We're going to lose so much money because of this thing happening. We'd like to see the debt forgiven. But how did the rules work? Well, the different banks gave all the loans, and then they were pooled together in a big pool, okay? And then the pool was managed by a super bank, and the super bank would be called, would establish a servicer. So the servicer, the job of the servicer is to send the letters to the homeowners saying, you owe this amount of money, please deliver it. And then the homeowners would deliver the money. And then if the homeowner wasn't paying, the servicer would say, you're not paying, you better hurry up and pay or we're going to throw you out of the house. Now the only person who knew the names of the homeowners was the servicer. None of the bondholders getting in the cash flows had any idea who the homeowners were. We knew their characteristics, what the loan to values were, stuff like that. We didn't know their names because by privacy, you're not supposed to be knowing any of the names. So the servicer is the only one with the knowledge and the only one with the legal right to change the terms of the mortgage. The servicer has the power to go and say, we'll forgive half your loan, etc. But the servicers didn't forgive a single penny of mortgage loans, subprime loans. Okay, so the question is, why didn't the servicer do it? So the servicer didn't own any of the loans, so it wasn't going to help the servicer. Okay, so that's number one. Number two, if the loan is for 100 and it gets forgiven to 50, the servicer fee gets cut in half. Okay, so the servicer gets 0.5% a year of the principal. So you cut the principal in half, the servicer fee gets cut in half. That's the second thing. The third thing is, to reduce the value of the loan, you can't just arbitrarily reduce the value of the loan. You have to reduce it to just below what the house is worth. So that means the servicer has to send an agent to the house and appraise the value of the house and think about, what the homeowner is going to do. Will the homeowner actually pay, or what's going to happen to the house? So that costs money for the servicer. So the servicer would have to pay a huge expense. And by the way, this isn't just 1 or 2 houses. These are millions of houses that have to do that. The servicers would have to pay a huge expense in order to hire the people to decide how much to reduce the loan. The servicer would get a lower fee for reducing the loan. The servicer got none of the benefit from reducing the loan. And most importantly, the servicers, who are owned by the biggest banks, JP Morgan and stuff like that, they didn't own those loans. They owned second loans. So a second loan is if you get an $80 loan on the $100 house, you can go out later and say, I'd like to borrow another $15 on the $100 house. Of course, the first guy gets paid first, and then I get paid. It's called the second loan. And the servicers the banks who owned the servicers owned all the second loans. So what would happen if they reduced the principal on the first loan? Obviously, they would have to reduce the second loan to 0. Or people were saying, if you're reducing the thing on the first loan, the second loan, which comes later, should be reduced to 0. So they'd automatically start an action that would wipe out all their second loans. So they had no incentive, exactly the opposite incentives, to reduce the value, to forgive part of the loan. So I went 3 times to Congress and testified and said, look, there's this tremendous collective action problem. There's a rational thing to do. The bondholders don't know who each other are. They can't talk to each other. The only guy who can do it is the servicer. He's got all the wrong incentives. You have to intervene. And so my plan for intervention, and I wrote this in the New York Times in 2008, an op-ed in 2008. So see how early it was. Okay, so here, October 2008 in the New York Times. Then I testified in Congress twice, and what the plan was that I proposed was that the government would intervene and say, okay, servicers, you keep your fees, you keep doing everything, you just have to send your data if you're, let's say you're from New Haven, Connecticut, my hometown, all the servicers who have houses in New Haven, you send them to community bankers hired by the government in New Haven. These community bankers will be given the job of looking at the loans, and they're experts in their hometown, and deciding what's the way to modify the loans to make the lender, not the borrower, the lender, as much money as possible. Maybe that's reducing the interest, maybe it's forgiving part of the principal. That's it. They make the lender as much as possible. That was the original contract that was signed. The idea was the servicer would act on the behalf of the lenders to make them get as much money as possible. I knew that if they tried to maximize the money for the lender, they'd end up forgiving part of the loan to the borrower. So, you know, I talked to all these Congress people. They all liked it, but the government, Obama and his advisors, weren't willing to do it. They thought it was too big a risk to take, and you know, so they didn't do it. But I think, and 17 hedge funds testified that they, who were the effective lenders, they owed the bonds, they'd like to see forgiveness. But it never happened. Not a single penny of subprime debt was forgiven, and instead we got this, you know, everybody redefaulting. And if you look at the losses, by the way, here are the percentage of people defaulting every month. So depending on the loan to value, this is combined for all the loans to value. If you had 140% loan to value, okay, the rate of subprime mortgages defaulting was 7.5% per month. So every month, another 7.5% of the people were defaulting. So and you're only getting 25% of the money back on those people who are defaulting. So obviously, you should have forgiven it. It never happened. And so I gave the graduation speech in University of Athens in 2011, and I said, look what happened in America. There are more homeowners, 20 million something homeowners thrown out of their houses for defaulting in America. This ruined the American economy for years. It made the lenders worse off. It made them worse off. I said, you may feel bad about yourselves in Greece because you're not going to be able to pay. Look how much, there are more defaulters in America than there are people in Greece. The American homeowners should have been forgiven for the good of America and for the good of the lenders, not for the good of the homeowners. And I predict that you won't have to leave Greece like my grandparents left Greece because there was no economic opportunity. I predict that Europe will eventually forgive your debt so you can stay in Greece. That was my 2011 graduation speech.